Dear investors, I wish and I hope that everyone is fine and healthy. Financial year 1920 was a challenging year for corporate India as pandemic hit the country in month of March. This has resulted in a significant dent in corporate India earnings. In fourth quarter financial year 1920, Nifty reported revenue degrowth of 5% and profit degrowth of 20%. For full financial year FY20, Nifty reported flat revenue and operating profit growth. Under those circumstances, I am very pleased to share with you that AAA PMS companies reported strong revenue and EBITDA growth of 9% and 15% respectively. In terms of net profit after tax growth, AAA PMS reported net profit growth of 20%, significantly better than the Nifty earnings growth of just 6%. In terms of return on net worth, AAA PMS reported 20% return on net worth compared to Nifty return on net worth of 12%. We strongly believe that in long term, market is mirror of earnings growth. If you look at this chart, then one can see the strong correlation between earnings growth and stock price returns during last 10 years. If you look at the dotted circle, the companies which reported 22% compounded earnings growth reported roughly about 29% compounded market cap growth. Companies which reported 37% compounded growth in its earnings, it delivered 40% compounded market cap growth. And therefore, earnings growth is something which is one of the most important driver of stock price returns. In recent first quarter FY21, corporate India has positively surprised the street by showing significantly better operating profit margins compared to the street estimates. Sectors like cement, consumer, healthcare, and information technology sectors have reported strong cost savings by reducing the cost on freight, rental, advertisement, sales, general, and other expenditure. Most corporates mention demand revival in month of June and they expect normalcy over coming quarters. Coming to market outlook, Nifty has moved up sharply from low of 7,600 to 11,000 levels, about 48% in just 120 days. There is a common question by investors. Why equity market is doing well when underlying economy is still going through slowdown? While we agree that economy is expected to take few quarters before coming back to normal growth, market is looking at future earnings. Importantly, economic power of sectoral leaders is increasingly moving up. The classic example is one of our portfolio company, Britannia Industries, the largest player in Indian biscuit segment. It has reported 26% revenue growth and 100% profit growth. Stories seen across our portfolio companies in various sectors like telecom, automobiles, cement, and pipes. We expect the formalization process, which started from demonetization, has accelerated further with GST and IL&FS crisis. But with COVID-19 crisis, even organized players with heavy debt on balance sheet will find it extremely difficult to survive and or to expand. Our investment approach of investing in companies which are market leaders with a strong balance sheet will not only enable the companies to navigate the downturn, but will also help it to capitalize on the upturn when economy revives. Our portfolio companies have zero or low leverage with very strong cash flows. Many of our portfolio companies in manufacturing segment have invested significantly during last 3 years. They will continue to invest to capture the future growth. They are rightly positioned in China Plus One strategy to attract the global customers as they have a competence and proven track record of execution. Friends, while we remain positive on market is never a linear line. We do not rule out any short-term correction. Indeed, correction would be healthy for the market and we will use such opportunity to deploy the cash. Thank you everyone, and I wish a good health to you and your dear and near ones. Thanks.